Two investors, same starting amount, let's say £50,000. Same market, same 40-year time horizon. These are illustrative numbers, not a guarantee of returns, but the direction of travel is real and well documented. Investor 1 puts their money into an actively managed fund charging 2% per year in fees. Investor 2 puts theirs into a low-cost index fund charging 0.1%. At the end of 40 years, assuming identical market returns of 7% annually, Investor 1 ends up with roughly £240,000. Investor 2 ends up with around £380,000. Same market, same time, £140,000 difference. The only variable is the fee, and most people have absolutely no idea this is happening to them. One man spent his entire career trying to change that. His name was John Bogle, and Wall Street hated him for it. Welcome back to the Investors Center podcast. I'm Isaiah. Today we're telling the story of the index fund, where it came from, why the financial industry tried to kill it, and why it quietly became the most important investing tool available to ordinary people. Before we dive in, head to theinvestorscentre.co.uk for our full comparison of the best FCA-regulated platforms in the UK. Everything is linked down in the description, so let's get into it. John Bogle was born in 1929, the year of the Great Crash, and grew up with a deep skepticism of financial complexity. At Princeton in the early 1950s, he wrote his thesis on a radical idea that most actively managed index funds, after fees, consistently failed to beat the market, not occasionally, consistently. The logic was simple. The stock market, in aggregate, produced a certain return. Every pound invested in the market collectively earns that return, but active fund managers charge fees for trying to beat it. Those fees come straight out of the investor's returns, and since not everyone can beat the average, by definition, the average investor gets average returns minus fees. The majority of active funds must underperform a simple low-cost index over time. In 1975, Bogle founded Vanguard and launched the first index fund available to ordinary investors. The idea was to simply buy every stock in the market in proportion and charge as little as possible to do it. No stock picking, no forecasting, no expensive analysts. Just the market at cost. The reaction from the financial industry was immediate and hostile. The fund was publicly mocked as Bogle's Folly. Competitors called it un-American. The argument was that deliberately aiming for average returns was a defeatist strategy, that serious investors should be trying to beat the market, not match it. Fund managers whose livelihoods depended on convincing people that active management was worth the fees had every reason to dismiss the idea. What they couldn't dismiss, eventually, was the data, because decade after decade, the data kept saying the same thing. Just a quick one from us. If today's episode has got you thinking about where your money is actually invested and what you're paying in fees, we've compared the best low-cost platforms available in the UK right now. The links are down in the description. Go check that out and we'll get straight back into it. Every year, S&P Global publishes what's called the SPIVA report, a scorecard measuring how actively managed funds perform against their benchmark index. The findings are remarkably consistent. Over a 15-year period, roughly 85 to 90% of active fund managers underperform the index they're being compared against after fees. Not because fund managers are incompetent, many of them are genuinely talented, but because the fees they charge are a permanent drag on returns, and over long periods, that drag compounds just as returns do, except in the wrong direction. Warren Buffett, arguably the most famous active investor alive, has repeatedly said that for most ordinary people, a low-cost index fund is the best investment they can make. He has instructed that when he dies, the money left for his wife should be put into a low-cost S&P 500 index fund. The man who built his career on stock picking is telling everyone else not to bother. By the time Bogle died in 2019, Vanguard managed over $5 trillion in assets. Index funds had gone from a fringe idea mocked by the industry to the dominant force in global investing. His original folly had become the default. Let's come back to those two investors from the start of the episode. That £140,000 gap wasn't the result of one investor making better decisions than the other. It was the result of one investor quietly paying away a percentage of their wealth every single year without ever seeing it leave their account. Fees don't show up as a line on your statement that says, "This is what compounding you lost today." They just silently reduce the base that your future returns are calculated on. And that reduction compounds year after year for decades. A fee of 1.5% sounds trivial. On a £100,000 portfolio over 30 years, it can cost you more than the original amount you invested in lost compounding alone. The fee is not the price of a service, it's the price of not knowing there was an alternative. What Bogle's work points to, and what we think makes sense for most ordinary long-term investors, is a low-cost global index fund inside a stocks and shares ISA with a regular direct debit and as little interference as possible. The ongoing charge figure is worth looking at before going anywhere. It should be well under 1%, and the best options are significantly lower than that. The difference between 0.1% and 1.5% sounds small. Over 30 years, it's not small at all. John Bogle didn't invent investing. He just figured out that for most people, the simplest version of it was also the best version, and he spent 50 years trying to make sure ordinary investors had access to it. This episode has not been financial advice, just information, and we hope you found it useful. If you want to compare low-cost platforms and find the best options available in the UK right now, the links are down in the description. Subscribe or follow so you don't miss the next episode. I'm Isaiah from the Investor Centre, and we'll see you in the next one.